Thank you, Stevie V, and hello, everybody. I hope you're having a great day. It's beautiful weather here in Leeds today, and welcome to this webinar on the taxation of crypto assets, an interesting topic. So here are the two people who are going to be presenting to you today. That's myself, Paul Davison, Director of PD Tax Consultants, and my learned colleague, Ryan Snape, who is a senior tax consultant with PD Tax Consultants. A little bit about PD Tax. Our vision is to enrich lives by making tax simple. And there's our mission there, quite long, but we're basically trying to do our best for our clients and stakeholders. So what do we do actually in terms of our day-to-day business? Well, we only do tax. It's the most important thing, really. And the prime piece of work that we do is tax advice, and that is for business owners and managers, individuals, trusts and estates, charities, and other professional advisors such as accountants, solicitors, financial advisors. We have our tax director service for accountancy firms, where we sort of white label stuff for the more trickier tax issues for those accountancy firms. We do valuations of private limited companies for tax and other reasons. We do tax investigations and voluntary disclosures. We also do tax returns, mostly personal returns, and they tend to be ones which are people with more complicated situations. So I think I'm going to now hand over to Ryan. Am I, Ryan? Because you're doing the bulk of the work. Thank you.
Bulk of the work. Morning, guys. Introduction to crypto. Well, hopefully some of you are quite familiar with what we're talking about today. Crypto assets is the term most commonly used by HMRC, which is how they view crypto. And in recent years, we've seen it become a much more recognizable part of everyday business. We're seeing it used as an asset. We're seeing it used as a currency. We're seeing it used as consideration for the sales in deals. And I think it's probably due to the flexibility of the use of crypto that there is some confusion in how it is taxed. And really, it's not necessarily crypto that's taxable, but it's the nature of the activity being undertaken that is ultimately going to determine how we are taxed, and very much crypto in many cases is just a medium in that sense. It's the activity that's taxable rather than crypto itself. Oh, just a second. There's a delay on my slides. There we go. So yeah, my section is basically going to follow, is going to focus on the buying and selling of crypto, which is probably one of the most popular uses of crypto assets. And the two taxes that we'll be looking at is income tax and capital gains tax. So for individuals, a capital transaction is taxed under capital gains tax. A capital transaction would involve the buying and selling of an asset, and that profit, where it is chargeable, would be subject to CGT. However, that same activity can be enhanced. It can be conducted with, and we'll move on to this, to such a degree of organisation that it might be considered that you're undertaking a trading activity. And I use the term trading here for its tax definition. I appreciate that trading's probably got a more normal definition in terms of the buying and selling of crypto. But a trading activity, if you were undertaking a trade, would the profits of that activity would be subject to income tax and also to national insurance contributions if you're an individual, which is just generally going to be a less favourable result. And I've just noted at the bottom there that HMRC doesn't consider the buying and selling of crypto assets to be the same as gambling, which I believe was a thought that went around a few years ago. Unfortunately, it's not gambling, and it will be taxable. Sorry, Paul, would you move my slides? It doesn't seem to be working at mine. Lovely. So how do we determine whether the activity that we're undertaking is that of an income tax or a capital gains tax activity? Well, fortunately, there's a wealth of guidance and case law that will help us to understand whether what we're doing is going to be income or capital in nature. And ultimately, the conclusion is going to depend on the facts of the situation. Generally, we're going to be undertaking a capital gains tax activity, and there needs to be quite a high level of organisation and risk and commerciality to what we're doing in order to enhance the activity that we're doing into that of income tax. And HMRC has said that only in exceptional circumstances would they consider businesses to be buying and selling exchange tokens with such frequency, organisation and sophistication that the activity amounts to a financial trade in and of itself. Yeah. There we go. So if you are fortunate enough to be that successful and sophisticated in how you conduct your crypto investing, that you are undertaking a trade, then you're going to be subject to income tax. The rates of income tax are there on the screen. We're looking really at the lower end of the scale, 29% tax and NICs, and therefore for higher and additional rate taxpayers, up to 47% of your profits from trading are going to be subject to tax at that rate. So generally, if you do find yourself in that position, we would be thinking about probably conducting that trade via a company, because a company is going to be a much more flexible tool. The profit rates are lower. Corporation tax is payable currently at 19% on the profits of a company, and there's not going to be any further tax to pay until we draw those profits out of the company. So we've got a much more flexible tool. So that'll be something to think about if you do find yourself buying and selling crypto assets and trading as a result. But in most cases, I think a passive investor is going to find themselves subject to capital gains tax on their buying and selling of crypto. Individuals have an annual exempt amount of $12,300 each year that they can set against their profits, their gains from the buying and selling of all assets. So if you're only buying and selling crypto, your first £12,300 of net gains are going to be outside the scope of tax. And it's also worth mentioning there that you can set your losses against your gains as well. Obviously, we're not out to find or create losses, but if you do generate them, let's set them off against our gains. And then in excess of that, if you're a basic rate taxpayer, any chargeable gains will be subject to tax at 10%, and then 20% for higher and additional rate taxpayers. And I've also mentioned at the bottom there about the Section 104 pool. That's more of an administrative side to capital gains tax, but where you have bought and sold the same asset, the same type of crypto, a lot of times in a period, there are specific rules for how you calculate the gains there, and you have to match purchases on the same day, made on the same day with disposals on the same day, and then match it with purchases 30 days after, and then you would look at your total purchases of that particular asset and set the base cost off in that way. So it's just it's more of an administrative side, but something to be aware of if you deal a lot in particular categories of crypto. And as the final part of this section, we're going to look at what is a disposal. Quite a simple question, and you would think would have quite a simple answer, but actually the results in terms of crypto are quite, well, personally, I think a little bit surprising. So disposal, if you sell your crypto asset for cash, that would be a disposal. If you get monetary value for it, and so you'd have to look at the amount you sold it for, what you bought it for, and the gain in between, and then that would be the amount that you would consider for tax purposes. But also the exchanging of a crypto asset for another crypto asset is a disposal of that first crypto asset. So I think I've heard it said that people think that if you don't turn it into cash, then it hasn't been disposed of. That's not true. If you turn it into another crypto asset, then you've disposed of that original asset, and you need to consider the capital gains on that asset if you were a passive investor. But I think the most surprising one is using crypto assets to pay for goods or services. We've heard the term of cryptocurrency. You wouldn't pay tax if you disposed of your Great British pounds. But if you were to use crypto assets to purchase something, that would also qualify as a disposal of that crypto asset, and you need to consider the gain on it. I suppose an equal way to describe it would be using a property to purchase a horse. No cash is changing hands, but you are disposing of that property as a result, and you would need to consider what you sold the property for and what you bought the property for. So what would be the market value of the property at the time that you disposed it, or the market value of the horse that you acquired. And then the last one there is giving. If you find it in the kindness of your heart to want to give your crypto away, that would also be a disposal, and you may have capital gains tax to pay. Even though that you've not actually received any consideration for the crypto, you are disposing of it, and we have to consider the tax position. Although if you do dispose of it to your spouse or civil partner, there is exemptions from capital gains tax for those types of transactions. So let's have a little poll. What do the people in the webinar today think is the tax that's most likely to be paid on activities involving crypto? A, CGT, capital gains tax; B, income tax; C, VAT; D, inheritance tax; or E, nothing. I'll launch the poll now, and you can have. In fact, Paul, could you launch the poll? I don't seem to have the option. Well, here we go. Sorry, got it. There we are. Maybe 30 seconds just to send us your responses, and we'll go through the results. Okay, I think that's nearly all of you that have responded in the poll there. I can reveal that the overwhelming majority have said that capital gains tax, 90% of you have said that capital gains tax would be payable, which shows that many of you were listening in the first half. And were a couple of votes for B, income tax, and E, nothing. So perhaps not everybody was listening. But I'll now pass you back over to Paul, who's going to cover some of the other activities that would involve crypto assets and how those might be taxable. Thank you very much.
Thank you, Ryan. Well done. So a couple of activities involving crypto to talk about now. I think what Ryan said there was pretty important about it's the activity that's taxable, not necessarily thinking it as a currency, is what you do and it's taxable. That rang true to me there. So if we think of that through, crypto mining, what are you doing crypto mining? Well, you're beavering away there to try to create something. So basically it's subject to income tax because you are doing something with an end goal and receiving something for those services or work, so to speak. So if you spend every day of your life mining for currency, then that's probably going to be trading. Don't have to be your business. That's what you do. That's who you are. You're a crypto miner, and you'll get taxed as trading income. If you don't do it, if you do it sort of in your spare time, it's treated as miscellaneous income, which is actually quite a similar type of treatment to trading. So it's not really much differentiation there. So what we're saying is basically crypto mining subject to income tax, and the profits you can deduct the costs of mining against the profits. So you receive the currency, it comes into your folder, whatever, and then you can offset costs that you spent, power, blah, 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 in terms of actually mining that. If you put it through a company, you could possibly charge you some of your personal time as a salary against it, but it's treated as profit. And it's important to note that the profit arises once it's mined, not when it's converted into a different currency or when it's disposed of, like Ryan was talking about earlier. So that's quite clear. Crypto lending, a little less clear, a bit more muddy. But I think again, if we think it through, what we're doing here is we're sort of, if you give your crypto to a platform to lend, then I suppose the question is, how is that taxed? It's not going to be interest. It could be interest, but it's only going to be interest if you've given that crypto to somebody else and there's specific terms about what you're going to get back. So if you're going to get a percentage back over a period, then that is going to be interest. It's not actually treated as interest, it's treated as income, but it is going to be more akin to interest than if you lend it to a platform and the terms of the lending are such that actually this could happen, that could happen. There's more of a risk because the currency is in its infancy or whatever. So if there's more of a risk involved in you actually lending the currency to the platform or to whoever, then it's probably more likely to be capital because you are taking more of a risk rather than interest, which is more akin to income. It could be, again, like Ryan said earlier, we could be trading and lending, but actually HMRC said it's going to be sort of exceptional when you would be deemed to be trading in terms of lending to cryptocurrency. So that's interesting. Now we've got the final section. It's quite a long section actually, and it's on admin and record keeping, which I think is quite important. So that's that first statement there. I'm going to read it out, which is, this is what you sign when you sign your tax return form. It says, I declare that the information I've given on this tax return and any supplementary pages is correct and complete to the best of my knowledge and belief. I understand that I may have to pay financial penalties and face prosecution if I give false information. That's quite a high threshold, but it does include the words to the best of my knowledge and belief. And we know that keeping records and information from platforms could be sketchy. But even if it's sketchy, it's no excuse to say it's sketchy, I didn't keep a record. It is down to you to keep that record. And sometimes you might actually never know what's underlying the transaction, I believe, but actually, if you know the overall outcome of that transaction, and you understand there's been conversions or whatever in relation to that overall outcome, then you should record that, and you should give it the best possible thought about what's happened. Because as I say there, it's down to the taxpayer really to keep their own records. And really what they should be doing is keeping a spreadsheet, for example, of what's happened, or keeping information from the trading software in an appropriate format. The appropriate format is going to be listing those transactions, trying to categorize them where you can, and do your best really to keep something that's sensible. And as Ryan mentioned earlier, make sure to keep a record of losses because you can offset losses against gains, so the losses could be valuable. The underlying problem, the underlying issue here is that actually, if you don't keep records and take the mickey, then HMRC could levy an estimate on you, and that estimate could be fairly spurious. And at the end of the day, if the HMRC dig their heels in, it could go to a tribunal, and then the taxpayer would have to disprove their estimated assessments in that tribunal. And then in terms of how long to keep information, well, if you're trading, there's a requirement to keep that information for 5 years from the 31st of January following the tax year of the return. If you're not trading, i.e. it's capital gain, you're doing it as a bit of a hobby, you got to keep your records for a little bit less, 22 months from the end of the tax year to which they relate. If your tax returns are submitted late, then these limits will be extended. Don't forget, if you're a pay-as-you-earn person who doesn't necessarily normally file a tax return form, but you do have crypto and you do have gains, which are taxable, especially if they're above the capital gains tax threshold of £12,000 odd, you will have to file a tax return form. It's your responsibility to file it. No notification from HMRC is required. And finally, HMRC do have access to information. They have sharing programs with all UK exchanges, and they've got details of transactions since 2014, we're led to believe. They also have know your client information from all UK exchanges. So that's the end of the webinar there on crypto. If you've got any other topics you'd like to cover, please email Laura at laura.b@pdtax.r. Upcoming webinars, Friday the 6th of May, we're talking about R&D. Okay, we're on to the most exciting time of the webinar. It's questions and answers. Laura, are you there?
I am.
Are there any questions today?
Yeah, we do. We have a few. So the first one is, what should you do if you have a client that's not declared profits from crypto trading for the last few years?
Ryan, do you want to take that one?
Yeah. Well, I mean, if that's the case, I think we've probably established that depending on the activity that they're undertaking, they're either going to have most likely capital gains or income tax to pay. So I think the first step would be to establish what's gone on. But with anything where you have underpaid tax, where you haven't declared your tax correctly in previous years, and you need to correct that position, what we would normally do is undertake a disclosure. So that would be a case of sitting down with the client, getting understanding what income and gains that they've had in the year, factoring in the crypto income and or gains, working out the additional tax and potentially interest and penalties, and then disclosing all of that information to HMRC. So it can be quite a long process, but it's better that you would come forward. If you would realise your mistake and come forward, it's much better from a penalties perspective to be the one that sort of self-assesses and self-declares, rather than say HMRC discovering the tax, the compliance failure. I believe there was a few letters I think that went out quite recently with where HMRC were nudging people that they knew probably had crypto assets or crypto gains to disclose it. So the point that Paul made earlier about them having access to platforms and know your client information is they probably do know that a lot of people in the country have had crypto at some point, and that's kind of the starting point for them saying, "Oh, I think you've got something." And if you have had a nudge letter, you sort of on the back foot then, because if you did have some gains or you did have some profits to declare, the penalties might not be as favourable. Yeah, we'd advise making a disclosure.
I think that's right. I think what's also important is if you do come forward, HMRC are more likely to say accept it and tick it. If they find out themselves that there's an issue, they're more likely to start to burrow into the issue and be a bit more determined to get as much tax out of you as possible. I think that's the nature of any disclosure.
Great, thanks, guys. A few people would also like to know what exactly crypto mining is. Crypto
mining is where you are, well, I'll try to explain it. Maybe Ryan can have a better crack than me. But it's where you spend time trying to crack some sort of computer type of code arrangement thing to actually gain the asset through answering a series of equations or logarithms or whatever it is. Fortunately, my brain is not that good when it comes to this type of thing. Do you have a better spin on that, Ryan?
No, I don't know if anybody, anyone, there's probably attendees at the webinar that could have a better crack at telling us exactly what exactly mining is. But I think the important thing to understand is that you're undertaking an activity with a view to getting a reward. So you're with a view to getting more, sort of getting a cryptocurrency or some kind of reward. And that's why it's trading, because you're doing something you're making quite positive, putting your time and efforts in to get a profit for yourself. And that's why it's generally treated as income tax. But the exact the nuances of mining, I couldn't give you a good description of, I'm afraid. Possibly some people could.
I think we're going to have a breakout session at the end as well, so we could probably discuss that. We also have another question. So presumably a gain does not need to be declared unless it causes a CGT liability.
I think there's a requirement that if the proceeds of a capital transaction are 4 times the annual exempt amount, then you need to declare it on the tax return, even if it doesn't result in an actual chargeable gain. So that would be somewhere in the region of about, if we've got 12,300, about £50,000 of proceeds. If we've got a single crypto disposal of that amount, you would still need to report it on the tax return, even if there was no tax to pay.
I think we said there's no tax to pay. You mean because the gain's not above the annual exemption?
Yeah, that's right. Yeah.
And also, you should bear in mind losses as well, because if you have losses, you have to claim those losses within a given period. There used to be a rule where you didn't have to actually claim those losses until you made a gain, until you made a gain to set them off against. But there's a rule, they changed the rules about 5 years ago, whereby now you have to claim the losses within a certain period and then offset them against the gain. So yeah. But yeah, if the gains, it's possibly correct that if your gains are below 12,300, you don't have any other capital gains, and like Ryan said, your proceeds are below that threshold, that you might not have to inform HMRC. But you certainly want to keep records of that calculation, really.
Great, thank you. I think that's all of the questions for now. Oh wait, there's one more. Is there a limit for claiming losses?
Sorry, can you just repeat that, Laura?
Is there a limit for claiming losses, period?
You say, is there a time limit? The time limit, did you say?
Sorry, I didn't hear you go.
Did you say, is there a time limit? Is that the question?
Yeah, I think so.
There is a time limit. I think it's 4 years, but I could be wrong.
Yeah, I think it's 4 years. I think you're right. I think it's 4 years.
4 years
from the end of the tax year that the loss took place.
Yeah.
So if it was just last tax year, that'd be April 2022. So you'd have to April 2026 to notify HMRC that you've made losses on.
Yeah, that's right. You could write it in a letter if you wanted to. You could tell them in a letter. But yeah, you do have to make some sort of claim in writing. Okay, well, thanks very much. That's the end of the session. It's now 10 o'clock. We're going to have a breakout